Hello everyone, welcome to a new episode where we'll be discussing the world of mergers and acquisitions. So let's get started. Firstly, let's talk about mergers. A merger occurs when two companies agree to combine their operations and assets to form a single entity. It's a voluntary decision made by both companies to merge their resources, talents, and capabilities for mutual benefit and growth. On the other hand, an acquisition is a process of one company purchasing another company. In an acquisition, the acquiring company gains control over the acquired company, including its assets, intellectual property, customer base, and operations. Now that we understand the individual meanings of mergers and acquisition, let's differentiate between the two. In a merger, two companies come together to form a new entity, sharing ownership and control. It's a collaborative effort where both companies contribute to the formation of the new entity. On the other hand, an acquisition involves one company taking over another, resulting in the acquired company becoming a subsidiary or being fully absorbed by the acquiring company. Now, let's dive into why companies select to pursue mergers. There are several reasons behind this strategic decision. Firstly, companies may opt for mergers to achieve economies of scale. By combining their resources and operations, they can benefit from cost savings and increased bargaining power. Shared facilities, technology, and talent can lead to reduced expenses and enhanced profitability. Secondly, mergers can provide companies with access to new markets and customers. By merging with a new company, operating in a different geographic region or targeting a different customer base, companies can expand their reach, diversify their revenue streams, and tap into the untapped markets. Thirdly, mergers can be driven by the desire to gain a competitive advantage. By joining forces with a competitor, companies can strengthen their market position, increase their market share, and enhance their product and services offerings. Now, let's shift our focus and see why companies select acquisition as their growth strategy. Firstly, acquisitions can provide companies with a quick entry into the new markets or industries. Instead of starting from scratch, acquiring a company allows them to gain immediate access to the established customer bases, distribution channels, and industry knowledge. Secondly, acquisitions can be a means for companies to expand their product or service offerings. By acquiring a company with complementary products or expertise, they can diversify their portfolio and meet the evolving needs of their customers. Thirdly, acquisitions can be driven by the desire to acquire intellectual property, patents, or technological advancements. By purchasing a company with valuable assets or innovative capabilities, companies can strengthen their research and development efforts and stay at the forefront of technological advancements. Let's have a look at the recent example of acquisition. In mid-March 2023, Switzerland's UBS Group bought rival Credit Suisse for 3 billion Swiss franc, which is about $3.3 billion. A move intended to shore up global banking system and prevent the latter financial institution from collapsing. This strategic move extends UBS lead in the Swiss market and strengthens its capital-light businesses. The acquisition brings benefit to clients and generates long-term sustainable value for investors. Leveraging Credit Suisse capabilities in wealth, asset management, and Swiss universal banking. Let's move on to mergers. India's largest housing finance company, HDFC Limited, and the largest private sector bank, HDFC Bank merger is one of the biggest financial deals in India. The $40 billion merger deal aims to consolidate the two entities and simplify their corporate structure, resulting in operational efficiencies and potential synergies. This merger is expected to bring various benefits such as streamlining the business operations and reducing administrative costs and enhancing the overall shareholder value. This consolidation will also simplify the ownership structure and governance of the entities, leading to improved transparency and accountability. This concludes our discussion on mergers and acquisitions. We hope this simplified explanation helped you understand the concepts and motivation behind these strategic decisions in the world of business.
If you have any questions or feedback on our videos, please leave them in the comments below. And don't forget to like, share and subscribe to our channel for more such videos. Till then, stay tuned for our next video on the valuation series.